weekend, and a lot of information came in this week. And let's start with that, and then we're going to work our way into where we go from here. But of course, economic data, let's start with that, Derek.
Well, the economic data was generally positive. Consumer sentiment came out on Friday. That was better than expected, the highest it's been in about a year, so that's a positive. We did see some PMIs both this week and last week that showed the economy is slowing. And the yield curve, as Danny mentioned in the preamble, is at the most inverted level since the early 1980s. Historically, that has suggested that a recession is imminent, but that may not be the case.
And it may not be the case because there's outside influence in that. But let's talk about this inverted yield curve being a precursor for previous recessions. It has been a good forecaster in the past.
It has. And one of the things we've talked about on our investment committee all the time is the playbook's a little different this time, given the COVID, given the lockdown, given the way different countries responded to it. But an inverted yield curve essentially is when short-term rates, I'll talk, let's say, 3-month Treasury bill, is trading at a higher yield than the 10-year note. And that's currently the case. The most inverted, as we mentioned, since the early 80s. But the interesting thing is, if you look at the 3-month Treasury bill, it's trading at about 4.7%. The CPI is trading at 6.4, so that's a negative real interest rate, right? But when you think about the 10-year Treasury at 3.65, 10-year inflation expectations are 2.2, so that's actually a positive yield. So really, in real terms, the yield curve is not inverted, and that may be something that I don't think investors have factored in.
You know, there's so many people right now, Derek, that are forecasting a recession for late 23 or early 24, and I've always argued that when everyone is standing on one side of the room, to be careful. But, you know, we're looking at an unemployment number that it continues to be a 50-year low in unemployment. And this is across all demographics as well. So that has been a really positive case. Now, let's take the other side of that argument. There is a possibility that the blowout number that we saw last week may have to be modified.
Well, it may, but the gist of your discussion is, I think, pertinent, and that is that we did see a much better than expected labor report, 517,000 jobs added. And the really good news in that was wage growth actually went down. So where did those jobs come from? They came from lower paid service-related occupations that perhaps employers who normally would lay off people in January after the holiday season, they just decide to hold on to their workers because people are having a tough time finding qualified people.
So let's talk about those layoffs, particularly in the tech industry. There's so many of these big companies, Amazon and the like, that have cut major jobs, tens of thousands of jobs. If you want to take the other side of that argument as well, that's going to improve their margins. That's not going to hurt their margins.
Right. And in addition, we've often talked about how the market cap of the tech sector is very high in the indices, but the number of people employed in the tech industry really isn't as big, isn't as representative. So the real interesting part about employment is where is it coming from the service side? That's where this economy is driven. That's where people's consumption patterns emanate from. So again, you know, people can focus on headlines all they want. What I see is a market that seems to want to go higher. I talk to any of our clients. They're all very nervous, much more nervous than they were last year when they really should have been. And at this point, you know, I'm starting to see green shoots all over the place.
You know, if you watch CNBC, you can get all kinds of different opinions. If you walk to the grocery store, everyone has a thought on where the market's going to go. And that's really, folks, what makes a market. There's two sides of it. And I thought, Derek, that we might spend some time on, you know, there's a lot of people who are very, very bearish, and there's some people who are more bullish, and then there's a base case. And if you kind of think about that as a continuum, I want to kind of go through that because there is a bull case and there is a bear case. And let's start with the negative side first.
Well, the negative side is the level of inflation is still well above the Fed's target of 2%. Another part on the negative side is that earnings revisions continue to be negative. So we're looking at potentially negative earnings growth in 2023. And given the recent run-up, valuations are no longer attractive. Finally, corporate margins are starting to roll over, which will negatively affect their company's ability to pay dividends and do buybacks and the rest. So the economy and corporate fundamentals are certainly a headwind, but there are tailwinds, as you're about to talk about.
Yeah, but that's before we go into that. So the bear case, of course, is that the total earnings, the earnings of the aggregate S&P 500 comes out to a certain number. A lot of people are in the high 200s or so. In the real easy math, if you multiply that, say, call it 220 by the current multiple, that puts you at a number that is actually lower than where we are today, trading as of the close on Friday. So there's certainly an argument to be made that we may be overvalued right here. But as we just said, let's take the other side of the coin now, if you will, the bull case. And the bull case right now suggests that there is a lot of positive things out there. Most importantly, we started out with the plus 8% in January, and as January goes, is often a harbinger how the rest of the year is going to go.
That's right. And there are other technical indicators we've seen. For example, Bespoke, one of our research departments, mentioned that 12 out of the last 13 days, the S&P has closed above its open. In other words, the market traded up throughout the day. That's only happened 7 times, and in each case, it was in the midst of a bull market. The other bullish thing that people have to consider, too, is equities typically bottom and trough 6 to 9 months before earnings reach their low. And if you think of October as the potential low, that would mean that earnings revisions to the downside would end somewhere around the middle of the second quarter. So this rally that we're seeing could simply be a recognition that a lot of the negativity is already priced in. And we also know China's reopening. That's going to have an effect, too.
So let's go back. You talked about October. We've certainly seen a rally that has started in October. So is this a bear market rally, or is it the beginning of a new bull market? It's hard to say, but there's no question that the Federal Reserve has an overwhelming influence, at least on people's thinking right now. So the Fed, obviously raised rates again last week, talking about raising them again to try to tamp down inflation. But inflationary pressures are still there. Let's talk about energy for a second. I mean, if you think about what is going to be inflationary, we have a number coming up. We have what's called rental equivalency and energy prices, both going to put pressure on the Fed.
Right, and energy prices are up recently, and we've seen gasoline prices begin to tick up at the pump. We know that oil prices have moved up. We saw on Friday that Russia was going to cut oil production, and in the meantime, we need to replenish our strategic petroleum reserve, which we managed to diminish
a million barrels
in
a day
in front of the midterm election.
Right, for 200 days. So that's got to be replenished, and of course, at the same time, that is, of course, a demand-supply issue. You've talked about Russia cutting back. They already announced 1 million barrels a day, and as you said on Friday, they had added another 500. So all in, that's 2.5 million barrels a day. That's significant. So that will put pressure on oil prices. If oil prices go up, gas prices go up. At the same time, we're looking at what's happening in the housing market, and it really hasn't cracked. It started to come down, but it really hasn't cracked. So with all of this information, there is a possibility that we can get a soft landing, and that is going to be an argument for the bulls.
Well, and I think the odds of a soft landing in 2023 are very high, frankly. That jobs report certainly put the soft landing argument in better footing.
Can I interject? That is if that jobs report stands. There's some people who say that jobs report came out, political motivation before the State of the Union. That's an argument that some people are making, and that is going to get revised downward. We'll have to see.
Well, I'm the first person who doubts government statistics, and I certainly don't. When I think about our portfolios and how we're positioned, I really try not to spend too much time reacting to the most recent headline and think more longer term. And the way I look at the situation right now is playing defense makes a little bit of sense, right? Let's have a neutral allocation to equities because we know not to fight the Fed and valuations are levitated. We should diversify geographically because there are other parts of the world that actually are seeing relative earnings growth better than the United States. And then finally, let's accept change. Let's accept that the leadership of this next bull market, when it emerges, may be very different from the leadership we saw in the last bull market.
And that could be your base case. Of course, we really don't know. And all of this volatility, as Derek just pointed out, really presents opportunity. But there's something that we cannot manage to, and we call that incident risk. And incident risk is everything that is, the uncertainty of what's happening with Russia, and of course, how does our relationship go with China? These geopolitical risks are something that you really can't manage to. And that is the reason, folks, you have to go through your portfolio and make sure it's balanced. Make sure that you understand that your risk is tied to where you're trying to go. That's why we go through these portfolios, through every single holding. If you're a prospect, we go through every single holding. Should you hold it? Should you sell it, or should you reposition and do something else with it? That is what you get when you come to Annex Wealth Management.